Good morning and welcome to Retirement Tax Matters. I'm Adam Reed. This is Garrett Crawford, our resident CFP. How are we doing this morning, Garrett?
March Madness, baby.
March Madness, yeah.
I was just thinking about that when I rolled in at lunch today. All the games start, all the financial planning, March Madness, it all mixes together today.
It honestly kind of works out well for us with tax return-driven financial planning. Really, rubber meets the road April 15th. A lot of our clients start sending their tax returns over, and we start reviewing, and maybe not all of our client-facing work, but a lot of our behind-the-scenes work starts here in a couple weeks. And so it's kind of nice we get this, and then the Masters comes along in the middle of April, and so we get to kind of have that peacefully going on in the background as we're combing through tax returns.
That lull between like NFL football ending and college football ending starts to pick back up for the sports aficionados. But March Madness, I think probably the first two rounds, or at least the first round, today and tomorrow, I think are the best day in sports all year.
Oh yeah, get to see some exciting stuff. Yeah. So, well, picking up from last week's episode, last week we kind of kicked off a part one of we're in kind of this series of early retirement and how that affects you. And so last week we looked at kind of part one of some different accounts, how you can access them, different kind of some niche underground rules that maybe not a lot of people are aware of. And so I wanted to pick up part two this week and talk maybe specifically on Roth and brokerage accounts. And so I think maybe to kick off this week, we had a commenter, I think it was Chase, that said, hey, you actually can access your Roth before 59 and a half, and we agree with that. You know, that's a possibility that's on the table. But maybe give us some thoughts or guidance as to why you might steer somebody away from that if they're trying to bridge this gap. They're retiring at 55 and they're trying to find, how am I going to live off the money that I've saved? I've got plenty, but I don't want to be paying more than I need to be. What are some thoughts you have on the Roth conversation as those people are trying to bridge that gap?
Yeah, and I would probably set a precursor to this conversation. Last week's was a heavy lift. So, like, if just prepping for that one, it's not something that I come across too often, and so just wanting to be able to speak intelligibly on it and making sure even as financial planners, we have our biases, right? It's like something you don't use a lot. You can kind of think is not a great tool, but last week's episode was about how do we use our pre-tax money, 401ks, traditional IRAs, if we're going to retire before 60. A lot of y'all worked in the age where you had to contribute to a pre-tax account. And getting that money before age 60, go back and listen to the episode before this, but it was on substantially equal periodic payments, which is how you get money out of an IRA before age 60 without the 10% penalty. And then also the rule of 55, which is how you can get to your 401k money. Very technical episode. And I bring that up because I feel like today's episode is like the heart of early retirement. And so it's like you've got, I know we're going to talk about brokerage accounts here in a second, but you also have a Roth IRA account. And the good news is, according to Chase, he referenced it on our social media post, you can get to your Roth money before age 60 without that dreaded 10% early withdrawal penalty. And so a lot of people don't know that. Even in your early working career, if y'all have kids, there's all this question about, liquidity. What if you need that cash and you're putting it away for retirement? One of the coolest things about a Roth IRA is that you can get to the contributions that you make to a Roth IRA penalty-free anytime. And so there's a difference when we look at our Roth IRAs. It doesn't show up on your statements usually, but it's the contribution amounts, the amounts you've contributed through the years. And then the second part, or the second component of that, would be the earnings associated with those contributions. And for the Roth IRA, if you try to access the earnings before 59 and a half, those earnings will come out, they'll be taxable at ordinary income rates, and then you'll also get hit with a 10% income or 10% early withdrawal penalty. And so you don't want to get to your earnings before you get to your contributions, but those contributions can come out at any time. So if you're considering an early retirement and you have a Roth IRA that you've been contributing to for years, you can get to the contributions. And one of the rules that allows you to do this very easily is there's an order of operations when you pull money out of a Roth IRA that the IRS accepts and you can conform to. But when you pull out money from your Roth IRA, it's considered contributions first. So even though you have these two mixes of money, the IRS assumes that any money withdrawn is contributions first. So that's pretty cool for an early retiree.
That's nice of the government, who typically makes things maybe a little more complex on us. So they toss us a freebie on
It's
that
usually the other way around. The penalties are first, and then you get to the contributions. So that's a cool feature, and that's why when I posted this very short social media clip, I didn't reference the Roth IRA. And so the person said, technically, you can get to your Roth IRA before age 59 and a half. And so I agree with that. And so I think the point of this conversation is, while that's true, I don't think you and I see that very often, where people want to retire early and then use Roth funds as a bridge to, age 59 and a half or late 60s. And this would be my opinion on the idea of using a Roth. But most of the time, when high net worth retirees between $2 million, $8 million, they're thinking about retiring before age 60, it's usually because they have excess. They have more than they need, and they're starting to realize, why am I punching the clock, 40 hours a week, 50 hours a week when I've got more than enough saved? And so wouldn't it be great if I retired early, maybe did something else that I enjoyed more? But you get into this situation where you have to worry about these early withdrawal 10% penalties before age 59 and a half. And I saw a comment somewhere, and I've remembered this for years, but if electricity went out in your house temporarily and you didn't have firewood ready, would you go chop down your fancy furniture and use that for firewood just to stay warm for a couple hours? And I think that analogy has always rung true with me, because your Roth IRA, the money that you've contributed all these years, it's growing tax-free. It's one of your best investment accounts. And I would say there's a really high correlation between high net worth retirees and not running out of money. And while there may not be this priority of giving everything to their children, there's usually a lot left over because compounding interest gets out of hand. It keeps growing. They can't spend enough to keep up with it. And so there's usually significant money left over for children or beneficiaries. And so while it is possible to use a Roth IRA for early retirement and using those contributions, it feels like robbing from one of your best assets in order to fund this kind of splurge thing in life. And I see where if people can leave that Roth IRA alone and let it keep growing, they like that it continues to compound tax-free. They like that if there's money left over, it goes to the kids tax-free. And they love that the kids will have an additional 10 years of tax-free growth. And it makes things extraordinarily simple for beneficiaries' inheritances. And so while the Roth IRA is possible, I think there's just something that unsettles a lot of early retirees from using the Roth IRA as their go-to fund source to fund an early retirement.
Well, I think this is just a good discussion to be having, because maybe some of our older viewers that are at that age and they're ready to kind of hit the eject button, they're looking and saying, what do I have on the table? What are my options? But maybe for even some of our younger listeners that 30s, 40s, and they're like, hey, this is what I want to do one day. You can go ahead and start positioning some funds and say hey, I think I do want to call it quits. I didn't even think about the 59.5 rule. And so I think this next account, you've kind of alluded to it, I think in the first episode, and then maybe even some comments you've already made, but maybe one of the best assets, not best assets, but best type of accounts, one of your assets of repertoire of accounts that you can have for an early retirement specifically, but even just flexibility in general. Is a brokerage account. And so maybe you can give some insight into that. Somebody that's maybe got all the different types of accounts, they're thinking, where do I start? Or maybe the person that's looking forward to an early retirement, what is the strength and what is the kind of position of the brokerage account for the early retiree?
So just take a couple steps backwards and 30,000 foot upwards. Traditional IRA, to get to that, you've got to use those substantially equal periodic payments, which can be kind of a burdensome contract of fixed payments you have to stick to. You might be able to use the rule of 55, which can actually be really good if you know how to implement
the 401k.
The 401k. And then we just have the Roth IRA account, which is tax-free money that you can get to. It's actually really cool. It's flexible, but it's like kind of taking your best money out. And so kind of at a default level for wealthier retirees, a brokerage account can be the most wonderful type of account to retire early on because it has ultimate flexibility. You can use as much as you want. You can use it whenever you want. You can save as much into it as you want to. And it also is eligible for preferred long-term capital gains rates if you hold a security for longer than 365 days. And so, I get this feeling a lot, especially when I'm reading literature online, which isn't always the real world, but people have this assumption that traditional IRAs and Roth IRAs are the best type of account to invest in. But the brokerage account sometimes feels like second rate or behind a Roth IRA or a traditional IRA because you're having to pay taxes as you go. But if you're in a very high tax bracket, 32% or above, and I'd really even go down to 22% and above, the brokerage accounts feature of letting that growth be taxed at a lower long-term capital gain rate. For a lot of people, it could be 15%. It might be 18.8% if you have the net investment income tax, and it can go up to 23.8%. But that is a lot better than 32, 35, 37%. And so
the way it's structured, it's always a discount.
Yeah.
Regardless of what some areas it lands, it's a bigger discount, but it's always a discount.
Yeah, and so I think I'd start with the brokerage account, even from a tax perspective. Yes, you're having to pay taxes on it as you go. It's not deferred like an IRA, and it's not tax-free. A brokerage account has a wonderful place in a high-earning, soon-to-be retiree's portfolio. And, even if you're watching this episode, maybe you're in your 40s and you saw the title and the niche, and you're like, man, I think I might be there one day. I would strongly encourage somebody that's thinking about early retirement to go ahead and max out a 401k. Maybe you're doing pre-tax, maybe you're doing some Roth in your 401k, but I would not feel slighted one bit once you've reached that employer maximum contribution amount to begin funding a brokerage joint taxable account with extra money. And there's no limit on that. So if you maxed out your 401k and you still had $30,000 left, a joint brokerage account that you could invest in for 20, 30 years could provide a lot of money and a lot of flexibility for you to retire before 60. Because again, one of the things that we see is high net worth retirees, they've probably maxed out a 401k for decades. And so it's grown to be, I see a lot of them, they're in the $2, $3, $4 million range. But because of that annual maximum cap, what they end up doing is they contribute to a brokerage account, and sometimes we'll see brokerage accounts equal and surpass the IRA value because they had nowhere else to save. And I think it's not uncommon for a lot of people that are out there to have a very large brokerage account, and that is going to be almost the default ticket to your early retirement and an early peace of mind.
Yeah. So I think to kind of put a bow on it today, how would you counsel someone and say, like, hey, this is why I think tax return driven financial planning is so important for somebody that's 50, 55 years old and thinking about this, and maybe that'll lead into just reminding people about our checklist with tax returns coming back and everything. But this conversation, just like most conversations we have, I think tax return driven financial planning is so important. Tell us why.
So I think, as much as I say, like the IRA is more complicated to get to before 60, and the Roth IRA, that's your best money, and the brokerage account is your easiest money. Tax return driven financial planning is going to be taking an annual year-by-year look at your expected income, and there's going to be reasons why it's not as simple as just pulling all of your money from a brokerage account or using a substantially equal periodic payment. There's going to be reasons why somebody would go one way versus the other. And I just had one the other day where we were going to liquidate a large, highly appreciated security to make a big purchase for a client. And we kind of made a decision, and I said, hey, let me check last year's tax return. Let me do another review on your projected income before the end of the year. And what I find out that I would not have figured out had I not taken the extra step of doing the projection was that we were going to unnecessarily trigger the next Medicare IRMAA level, which was going to be like an extra, I think maybe $1,000 per person. So like $2,000, which in the grand scheme of thing, somebody's got multi-millions, probably not the biggest deal. But nobody likes making a mistake that could have been avoidable had they been looking at the details. And I think that's a microcosm of what we do with tax return reviews, tax projections, income projections, is that we are analyzing a very unique situation, purchases, withdrawals, savings, contributions, and we're trying to usually max out a tax bracket or not create a net investment income tax situation. And if you do those little things year by year by year, I think that's the best way to, we call it alpha. That's a technical advisor term, but like create value for our clients is by not making little mistakes each year.
Yeah. And so I think for those of you that work with an advisor, ask them, hey, will you review my tax return? Or if you want to spend time with us, go to the website, and there's a time to book a call with Garrett. And then in other ways, if you're a do-it-yourself or you watch these at home and you say, hey, I love doing this, I'm going to get out the pen and the paper and go to town, check out the year-end tax planning checklist. It's on our website. It's a free resource. The link is down in the description below. And I think it'd definitely be worth your time. And I think add alpha, where we just learned, some value to your planning this year. And so,
absolutely.
If you guys have any questions, throw them down below. As you guys know from this episode and the past episode, we go through, we read those, and it creates good content and good conversations. So would love to hear some of your all's thoughts. Check us out on YouTube, Spotify, Apple. Like, subscribe, follow, all those things so you don't miss any of these tips, tricks, and hacks as you do your tax return driven financial planning here starting in the next few weeks.
I was going to say best of luck to your March Madness basketball team. I think we'd have to say big go Vols, although expectations are probably a little lower this year.
Yeah, let's hope everyone's tax return driven financial planning projections go better than your March Madness bracket this year. Unless you nail it, unless you're the first person ever to nail it, in which case congratulations. But, anyway, thank you all for joining us this morning. I'm Adam Reed. This is Garrett Crawford. Retirement Tax Matters.
Thanks so much for listening to Retirement Tax Matters. As always, the ideas we share here are for educational purposes, and we do our best to get it right, but this isn't a substitute for specific tax or financial advice, because a truly effective strategy is always built around your personal situation. For more resources and to see our full disclosure, visit us at retirementtaxmatters.com.